I mean, it's like the last question, so I guess I'll just wait till.
Okay. This is the Brentwood Associates.
Yeah.
They are an equity slash venture capitalist firm
Yeah.
that uh, has some strong investments into companies that they run, and um, the particular company that they've purchased is called Zoe's Kitchen, and
So,
they're looking to do an initial public offering. So the main discussion point here that we begin with is deciding whether or not we will exit Zoe's Kitchen now, and if so, what's the best exit option? As a vote, as a group, we should vote what Brentwood should do with Zoe's Kitchen. Um, to exit means to sort of exit the investment, to realize the investment and receive a gain or a loss. Hopefully a gain. And the question here is which option is going to give the company the best gain for the situation. So the options are: do they do the initial stock offering now? Do they sell to a strategic buyer or a financial buyer, or do they try to grow the business and wait till it becomes more valuable before they exit the investment?
I think they should um go IPO now.
Um, that's what I said as well.
Sounds good.
Wait,
Fantastic.
you have to say yours.
Mine?
Yeah.
I said mine. I like the I like the IPO decision.
Yeah,
So you will okay.
yeah. He just uses less words, or
Okay.
Yeah.
or sounds indifferent about it.
I do not like my right words. I prefer my left. I like the IPO thing just because it will give them additional, it will end up giving them additional capital that they need to be able to grow and spread out
Well,
to
yeah,
try
and
and
the business will be value more. Will be more.
Right? Do you guys remember Dropbox?
Yes.
yes.
So Dropbox just announced their official announcement was today or this week that they're doing their IPO.
What's their IP, what is their IPO? Did they say?
I think they're trying to raise $500,000, or excuse me, $500 million. I think their sales are getting. I think their sales are approaching $1 billion.
Darn.
But they're still technically losing money.
They're still losing money.
Yeah, but
It's probably
if
all
I,
that
had,
free space.
if I had some money, I'd probably buy it just because technology IPOs usually go up the first few years, because of just the hype, the buzz.
So did they actually say how much the IPO was?
Like
The
the
share price
like the
was?
price per share.
Yeah.
No, I didn't hear about that yet. I don't know if they had decided yet.
Hmm.
I think that comes. I think that's still a little ways away. Okay. So Brentwood Associates, so they own Zoe's Kitchen. They bought it from a I guess it was a family owned business. They've grown it to about I think 100 locations, and we've decided as a group that we think they should do the IPO. And so, what's the question? The next question is we said we had individually state our position, and if we all agree, take a counter position and explore why you should choose those other options. So Charles, you mentioned that it's going to raise cash. It's going to help them raise more money. Um, I I would add my 2 cents is that it will add some prestige to their business, some popularity to kind of
Going
put them on
IPO?
the map a little bit. Yeah. Going
Oh,
public with a company, they're going to get some attention from that.
yeah.
So which will make their venture capital firm, more
And
popular.
I also noticed that when I did like the value of the company, um, it shows that it was around the same worth as the Noodles and Company
Mm-hmm.
petition. Like they were almost the same when Noodles and Company was like did their IPO. So it was like, I mean, like if they did good, because they were worried that they were too early.
Mm-hmm.
So it's like, I mean, it's worth almost the same amount as money has Noodles and Company. So I mean, they'll have the same impact. I feel if they do the IPO. That's how I thought about it. But
Okay. So what about the contrary positions?
I
Uh,
feel like the best one will be because they want to raise money. So I think the best one that they would do is the financial sponsor or strategic buyer.
right, maybe somebody who already has some restaurant chains or something like that.
Yeah, because the process is shorter too on that one.
So
Right.
It only takes like 3 months, and then we'll get their money fast and
Right.
start. I mean, their worth will be less, but will
When you
grow
say their
slower.
when you say their worth, you're talking about
I mean, validation,
the
valuation.
valuation.
Yeah,
Their earnings before interest and taxes and multiplied times the multiplier or whatever, six
yeah,
times.
yeah.
Uh, Charles, how about any thoughts on just growing the business?
any thoughts about just growing the business?
Yeah, as an option. What do you think about the option of just growing the business? Just waiting and kind of growing the business themselves, making it a little bit better.
By not having an IPO?
Yeah.
Well, that's possible, but the downside to that is that if you grow too slow, that opens up that allows competition to come in and sweep up all your potential customers.
Sure. Okay. Um. So the other question is in here. It asks why do they want to exit now? Like, why have they not just decided to grow? Why is now? Why
And
do they want
wasn't
to
it
exit?
because they were having like a lot of like calls or contact with banks that been wanting to like they've been asking if they were gonna go public or something like that.
Sure, that's
That
true.
was like one of the reasons why they were like thinking about the IPO. But then they also wanted to build more restaurants and they
Right.
needed the funding to do that, which they
They
didn't have.
and they need some money, right? They need the stock offering to do that.
Yeah.
Okay. That's a
Which
good.
that was also one of my reasons why I think they should go IPO because if banks are interested, that means that investors are already interested because they've been asking about it.
Right.
So
So the contrarian position, what are some reasons for holding now? What are some reasons for waiting?
I feel that maybe the management is not prepared to go public. You mentioned how the CEO didn't know how to communicate with the investors. And if they don't communicate the right way,
Right.
Business could go wrong. Um,
Yeah. So the downside of being a manager of a public company now is you have to be really careful about what you talk about and how you say it.
yeah.
And you were more liable to your to your investors. You have to keep your investors happy,
Hmm.
or they will end up pulling their money out of the company, and there goes all your capital to try and expand your own business. Oh, did you know that right now, currently, Zoe's Kitchen is trading at a
Yes.
$15 a share?
Yes. I looked it up and they're down. They went up to like 30 something and then now they're down.
Hmm.
They haven't been performing as well as Noodles.
As noodles?
Yeah. So what can go right under each scenario? What can go wrong? Um, so if they do the IPO, the issue is they could go through the whole process and then it could be delayed and become more expensive.
Yeah, the expenses are like, I mean, it was
And
like
then
10
yeah,
to
it's
13.
millions of dollars. And then what if something all of a sudden changes in the market? What if after a year the fast casual segment all of a sudden for some reason kind of starts to taper off and these other stocks like noodles drops, then their people aren't going to be interested in buying Zoe's.
Yep.
What about the cons of what about the what can go right or wrong if they just choose to sell to a strategic buyer?
Well, ownership plays a big part on that, doesn't it? They can lose ownership of it.
Well, I think at that point I think at that point they would. I would guess that they would just exit. They would sell the
That's
whole
true.
company. I don't think they would stick around.
Yeah.
But I guess if they
Well,
sold part of it, you're right. Yeah, they would have to deal with.
yeah, but if they decide to exit and they do not keep the business, then what can end up happening is they can actually end up losing money.
How would they
On
lose money?
Huh?
How do they lose money?
I said that they can end up losing money on the deal.
Right. Well, how would they lose money on the deal?
Because okay, if the company itself is not very valuable to other investors, under other individuals, then they will have to end up bringing their price down in order to unload the company.
Oh, okay.
However,
Well, they probably don't lose money, but they don't make as much money.
well,
'Cause
it's
I think they're going to profit. It's just they're not going to profit as much.
well, it the way that the economy, the way that finances go, the economy goes, it can it's very hard to tell what way things would go. Things might go things might go north when you think they're going to go south, and vice versa. It's very but the financial market is not always reliable.
Yeah. Well, okay. Yeah. There's definitely a risk that the valuation doesn't go as they plan. Sure.
Yeah. Um, case in point, that last what was it? Our case study from earlier this week, how the guy owned how the guys bought the company for $2 million, and
Sharpay.
and afterwards found out that well, all the company's equipment was all leased, so therefore he ended up losing money on the deal.
Sure, he had to come out of pocket another
Yeah.
75,000 or something like that.
So all I'm saying is, even if you think you're going to make money on a deal, it can always turn sour after the deal's been made.
Sure. Okay, so the next question I pulled up on the screen here, I just did some simple math asking about what the company is worth. And
I have a question about that
go ahead.
one.
Okay.
Why would the company be worth different in different in the different scenarios? Wouldn't the company just be the same? Does that make sense?
Yes, it does.
What's
I understand. The difference is because it depends on who's buying it. So for example, if it goes public, you have a bunch of people buying it, and they're willing to pay more.
So the value goes up.
And there's a lot more, scrutiny, and so you get to see everything pretty well. Whereas if private equity buys it, they don't want so much risk, and they're not willing to pay as much for it. But when they come to the table to buy the company, they're also not bringing the federal government with them to inspect and all that other stuff. So they figure, it saves time and money, so they should get a better deal. But also, I think it's just who's buying the company and what it's worth to them, just like anything else. A product that's in the Bay Area in California is worth different than a product that's sold in, Oklahoma. It would be the exact same thing, but the prices could be very different. So it's the same thing with a company. It's worth a certain amount to one group, and it's worth something else to a different group.
Yeah. Okay.
That's kind of the magic of capitalism. It reminds me of companies that build commercial buildings. So I have a landlord. I bought a building from him, and he's been doing real estate for decades. And he'll go buy a building that somebody built, and they'll build a building, they'll rent it out, and then once they get it mostly rented out or all the way rented out, then they put it up for sale. And I wonder, why would you do that? Why would you go through all that effort to build a building just to sell it once you get it all rented? Why not build the building and then rent it? So some people just build buildings and then they want out of them.
Yeah.
And so someone will go build a building and stick like a Rite Aid or a CVS or something in it, and then they sell it. And then he owns it for 3 to 5 years, and then he turns around and sells it. And it's like, well, why don't you keep it for 10 years? It's just this whole strategy of things are worth different to different people. Some people don't want to buy a building that's only been rented for 3 to 5 years. Some people want to buy a building that's been rented for 10 years. And some people only want to build the building, and the value that they sell the building at the day after it's built is different than the value when it's rented for 3 to 5 years, and that's different than the value that's rented for 10 years, assuming all things equal. So kind of the same thing. Just depends on who's buying it and why they want it.
Okay.
That's my input anyway. So these are my calculations. They're just straightforward. According to, correct me if I'm wrong, according to the case document, their earnings was 11 million. That's what I saw.
So I went by they talked about that in 2012 they made like 88 or 80 million, and I went by that one. Not sure.
So on page 5, it says that in August 2013, they're on track to have grown the stores and revenue to about 102 units. The revenue was up to 116 million, and the earnings was 11 million. That's on page 5. That's what I went with.
Okay.
If I scroll down to and by the way, the IPO estimated is $10 to $13 million in expenses to get to go public.
Yeah.
It's a lot.
I was like, whoa. And then an extra 1 to 2 million for recruiting.
Yeah, legal, I think. I'm looking for any other info here.
No, I can't find it. Where is it?
Yeah, it looks like earnings was 10,899,000, I think is what it says. So yeah, this is the calculation here. That's the difference. Just because on page like 6. Page 6. No, it is page.
You know, they must not have very many stores.
They have 90
90?
in 2013.
Well,
Page 9.
I was going to say they only have about 4,600 employees.
It's like 46 per store.
Yeah.
I was going to say on page 9, at the bottom of page 9, it says that the average multiples paid by financial sponsors and strategic investors were 8 times and 13 times. This compared to an average current valuation of 28 for publicly traded, fast-growing restaurant companies. So, and it mentions that a company called Yard House had 39 units, and they were sold at 20 times earnings. So let's see here. Any other thoughts on the valuation?
Oh, here it is. I found it. Wait a minute. So it says, I put it by the revenue though. But it says, Suits had revenues of nearly 80 million in 2012 and expected revenues of approximately 150 million in 2013. So that's what I went by the revenue. But I guess you can do it in several ways, right?
What did you find? So repeat that?
I found it on page 2, the second paragraph.
Right. That is their earnings.
Yeah.
we're 115, and so we're 80 million, and then revenues were expected to be 115, and then say the contrast, Noodles had 300 million, so Noodles was worth quite a bit more than Zoe's. Which I kind of wonder, like, to me, I think about it, I go, why would I want to buy stock in a restaurant company that's only worth 100 million? Like, I just, I don't know, maybe I could still make
There's
money.
actually, if you go, there's a, I don't know if you saw the chart. There's one company that was like one something.
Well, you know, that's how McDonald's started.
That's true. They weren't worth billions of dollars at the time.
Yeah, what's it called? Shuri's Holdings was 130 when they first did the IPO, their first IPO. Worth.
So to also answer the question that you had before, Zul,
Yeah.
what, you know, who knows how big these companies are going to get? So that's why I think the expectation is when a company is sold as an IPO, there's an expectation that it's going to get much bigger, and that's sort of the gamble, that it'll become, you know, $500,000 company and be worth 5 times as much, and then, you know, you've invested whatever millions of dollars, and now you have 5 times that. Okay. The other question is, all right, so we see the differences, and I think part of your question is, does it make sense of why there's different valuations?
Yeah.
It's a matter of multiples time earnings, and I think we discussed that a little bit. And the last question here says, why would anyone sell to a financial buyer instead of an IPO?
Didn't we talk about that?
Yeah, I think the only other thing I can add is that, I mean, it's a lot less work.
Yeah.
And I think if I look at my thing, if I could get 13 times and get $143 million and take that and go do something else with it, I would probably do that. I think. I mean, you get tens of millions of dollars more, but I don't know. I mean, assuming so, like Zoe's is public now. My question is, when the stock went up, and then now it's back down again. I mean, how did that affect Brentwood's? Or did they, you know, they get some money because they do the IPO, and then what happens if you wait 2-3 years and things go as planned, and the company's worth even more, and the stock price is worth even more, and then you start to sell out completely, and you make even more money? I mean, I think to me that would be the strategy, but I'm sure they wouldn't have. I mean, they can't predict it 3 or 4 years from the date that the stock's going to go down. I mean,
Yeah. You're always changing. It's always changing.
Is there anything else to discuss? I don't think so.
No, I think that's it.
So, all right, to summarize,
IPO.
So to summarize, we think we agree that that Zoe's Kitchen should continue on with the IPO as an opportunity to raise more money and build experience and awareness of the firm, and that while there are benefits of using the other options, there's a greater opportunity for financial reward with going with the IPO. And initiating the IPO now will take advantage of the current popular trend in the fast casual segment. and waiting would could result in a less popular time. So they want to take advantage of the popularity of that segment now.
Yeah.
Okay.
Okay.
Charles, do you have anything to add other
Yeah.
than
I do not.
cool?
Oh, I brought up McDonald's. Yeah. When McDonald's first went public, their shares were $30 per share. Now today they're worth $163.95 a share.
Yeah, but that doesn't take into consideration if the stock split.
Yeah.
So I don't know. The stock could have split 3 or 4 times by then, and so really that $300 or $100 a share is like $4,000 a share or something like that.
Yeah.
So between January 1st of 2003 and October 27th of 2012, the stock went up 672.06%.
Nice.
Yeah. Don't you wish you would have bought some McDonald's?
I don't think it's gonna do good in the
I
future.
I heard a story today. I listened to a talk from another class in B211, and the guy brought up how his grandfather was in a drugstore, and a guy would come, people would come in and try to sell him stock, and he always kind of dabbled in it. And at the time, cola products were popular, and there was one called Winola and one called Coca-Cola. And so he's like, guess which one my grandfather bought? He bought Winola. He says, we have a wall in like our, I don't know what, in his business or office, where we have a wall of all the stock certificates for my grandfather's purchases. He says none of them are in business today, and he never made any money on them.
Oh man.
He says my grandfather was not an investor, but what he was a really good druggist. You know, he worked at a drugstore, so he was really good at that. But yeah, imagine buying a stock in Coca-Cola when it was $1.
Yeah.
You did?
And now it's worth a lot.
So that was the guy's grandfather that I heard about that today.
Mm.
That's fun.
So anywho, all right. I guess we'll
Well,
convene again Tuesday.
yep.
All right.
10:30, right?
Yeah. All right. Thanks, Charles. Thanks, Soul.
Bye.
See you later.
All right.
Night.
Good night.